Hey, Jeff, let's talk about SoFi stock. It's been on a crazy run. I own some shares. I like the business a lot. There's a couple things I think investors need to know about it.
Yeah, I'm always confused by SoFi. People talk about it. It seems to get a lot of buzz. It's been on a crazy run. And then I look and I go, it's a bank. Tell me what I'm missing.
Okay, we can definitely do this. There are two things in particular I think people really need to know before they buy SoFi stock, before they sell SoFi stock, just really important things to know. This is Investing Unscripted. I'm Jason Hall. That's Jeff Santoro here with me. Before we get into the details on SoFi, though, we get to make these videos because we have a great partnership with the Motley Fool. The Motley Fool sponsors this video. And if you're looking for even more great stock ideas, the Motley Fool can set you up. Go to our special link. It's fool.com/unscripted. Go check out that link. You see it right there on the screen. You can get access to the Motley Fool's 10 best stocks to buy right now. For 30 years, the Motley Fool has been helping regular people like us become smarter, happier, and richer. Go check out that link.
I'm glad you framed this as things people should know before they own the stock, because I get how this works. You see a stock that's up 70, 80% in the past year, like SoFi has been. And it's very tempting to say to yourself, I got to get in on this. I must be missing something. This is the hottest thing. I have to have it. But even though you're a fan of the company and own some shares, you think maybe we should pump the brakes here and learn a little bit more about the company.
Yeah, I think that's right. So SoFi is a bank. That is a relatively recent occurrence. It's happened in the past few years after the company's IPO. It's one of the things that they did. And the reason they did that is at its core, SoFi's biggest and most important source of cash flows is its lending business. And if you lend money, you need money. You need capital to do that. And it had worked with a third-party bank that provided the banking services in the background for years. The downside of that is you have to pay a bank to do those things, right? There's cost to do that. So Anthony Noto has been the CEO since 2018, and I think he's done an exceptional job. Led the initiative to find a bank to acquire, to be able to remove that layer of cost from the business, and it's gone very, very well. Let's be honest. Being a fintech, because a lot of their other services that they provide, like they have a trading platform, for example. They own a business that does transactions for other fintechs that don't want to build that technology themselves. So they provide that service to other fintechs. So they have a lot of service-based parts of their business, but being a bank and being a lender is it's all about managing risk, especially when you are a bank, because now the money that you're lending out, you have the cash, which is an asset, and then the loan that you issue is an asset, but you have a liability on your books, which is deposits. That's the money that you owe to the people that trusted your bank to make a deposit, right? So I think Anthony Noto's done a really good job of managing that, because if you look at the growth rates of the business, they've been extraordinary. But the part of the business that's growing on the lower end is that loan portfolio. They're growing a lot of other things at much, much faster rates. They've also taken some steps to help de-risk the lending business. They've built a platform. It's basically a wholesale platform where they're selling off loans that maybe don't necessarily meet their lending standards in terms of quality. But there are plenty of buyers out there that are willing to take on that risk of lower credit quality to buy them. It gives them the ability to write more loans than they might necessarily want, and then to make a little bit of money selling those loans to other investors. So they've done a really good job there. But as part of what's happened with the stock, the share price, this is over the past 12 months, is up over 3x. It's up 237%, which is absolutely remarkable. And I'm willing to say that from these prices here, which again carried over really all of last spring, late the fall of 2024, and then all through last spring, I think the business was, I don't want to say undervalued, but like the risk reward, because the business had just transitioned into being profitable. And investors were not sure, are they going to stay profitable, or are they going to start spending money to acquire customers, and that's going to dip them back into losing money? They've stayed profitable, right? But I think the risk reward was crazy attractive. So I loaded up. I bought a lot more than I usually do and built a bigger position than I normally do in my early investments in a company. And then, of course, the stock has rocketed higher, got to almost $30 a share in the past couple of weeks. And it actually got to the point, Jeff, where I actually sold off some of the shares that I had bought, simply because the returns that I had earned and the price that the stock got to was a price I wasn't expecting the stock to get to really before, like 2 years from now, 3 years from now, if everything went really, really well. So it's not that the price has gone up, it's where the valuation is. So number one thing is, again, it's a bank, right? you have a lot of risk at banks with the economy. We've seen it's clearly a case of two economies in the US right now. A very small percentage of people are driving the vast bulk of consumer spending. A lot of other people are struggling, right? The employment picture is getting weaker. It's taking longer for people to find jobs. Younger workers, people that are looking for entry level work, the unemployment rates for Gen Z are in double digit percentages. So you think about those risks for a bank, they're significant, right? I don't think they're like things that could blow SoFi up, but there's certainly things that could impact its stock price in the near term. Which brings me to the biggest thing, the biggest risk, the most important thing I think investors need to know is that yes, SoFi growth is still the goal, right? This is still a small bank in the grand scheme of things, and its ability to become a top 10 bank is going to take it years to play out, and it should become much, much more valuable over time. But you still need to be mindful of the valuation that you're paying. And I think right now investors do need to be super cautious. I'm going to bring up here on the screen their earnings guidance for the full year. So at the beginning of the year, when they reported Q4, their guidance was for about 26 cents per share in earnings this year. They've raised that guidance. When they reported Q2, they're calling for about 31 cents per share in earnings this year. You start doing the math on that, and you're looking at paying 90 times earnings for this business at that price. And what that implies is there is extreme optimism that's baked into the business. Part of it is tied to the fintech aspects of their business.
Right.
But at the end of the day, I think for the most part, SoFi needs to be valued as a bank because it does still have the risks of a bank. And the expectations need to match up a little bit with near-term reality. So I'm not saying now is not a good time to buy SoFi Bank. I'm saying that I think now is not a good time to buy a lot of SoFi Bank. I think it's maybe a good time to open a position, maybe think about adding a little bit over time if you're slowly building out a position. But those are the two big things I would make sure investors need to understand before they even think about buying SoFi.